Hello and welcome. Today we'll be taking a look at Hamilton Enhanced US Covered Call ETF, ticker symbol HYLD. As you can see, it has a yield of 11.71%, which is fairly high, and it is provided by Hamilton ETFs, who do actually specialize in these high yield income oriented ETFs, and they generally try to provide a yield of at least 10% on almost all their ETFs. As far as I'm concerned, this particular ETF has been a bit of a mixed bag for me. So I bought it when it came out in February 2022. And to put it nicely, it hasn't exactly been a great experience. So in this video, I will be giving an overall review of what this ETF does. And at the same time, I will also share with you the lessons I learned of the risks of investing in these kinds of ETFs. So let's get started. As you can see on their website, they have highlighted the overall strategy for this fund. The primary objective is to give you a high income yield, but at the same time, they are also trying to give you exposure to the US stocks and give you an overall return which is similar to the S&P 500 index. And if we scroll down over here, we would actually see this information presented in the form of a graph. So since February 2022, the HYLD stock, and this is just the NAV or the stock price, and we can see that it has behaved similar to the S&P 500 index. But at the same time, HYLD is giving you a much higher yield for the income compared to the S&P 500 index. This might seem great at first, and it might also give you the illusion that HYLD is probably outperforming the S&P 500 index. But that is not actually the case. And we can actually verify that with a simple Google search. So if you looked up the HYLD ETF and checked its year-to-date return, you will find that so far this year it has only returned 0.85%. On the other hand, if you looked up the SPY ETF, which does a really good job of tracking the S&P 500 index, you will find that it has returned 13% so far this year. So clearly, the S&P 500 index has outperformed the HYLD ETF. Even if we were to add this 11% yield to this 0.85% return for the year, the S&P 500 index would still outperform the HYLD ETF. Now, this is not exactly a bad thing. In fact, with a lot of covered call ETFs, it is expected that they would underperform the underlying holding. The main reason most people buy a covered call ETF is not for a higher total return, but rather for a higher income yield. But I wanted to highlight the aspect of underperformance, mainly because the way these graphs are presented might make someone think that this ETF has the potential to outperform the index, which is certainly not the case. Alright, so now we are going to take a look at the holdings within this ETF. And as you can see on the screen, it does not actually hold any stocks directly. Rather, it holds a number of covered call ETFs. And some of these ETFs you are probably familiar with, like JEPI and JEPQ have been quite popular recently. Also, QYLD, RYLD, and XYLD are among the oldest covered call ETFs on the market. And in addition, you have some Canadian covered call ETFs like QQCC, which is very similar to the QYLD. I would almost call it the Canadian version of QYLD. And the USCC, which holds large cap US companies, GLCC, which mainly holds gold producing companies, and NXF, which is mainly energy companies, as well as this one, which has healthcare companies. So you get a broad mix of different sectors by holding all these different ETFs. But in addition, you also get a broad mix of covered call strategies. So, for example, QYLD writes covered call on 100% of its holdings and at the money. So you're giving up all your potential capital gain uh, in QILD. There is no potential for any capital gains. You're just receiving the premium. And I think QILD pays out like 1% of its every month, and the remaining gets invested back in the fund. But there are some funds who sort of use a more dynamic approach and write covered call on like 25 or 50% of its holdings. So NXF, for example, writes covered call on only 25% of its holdings. So with the remaining 75%, you actually have the potential to make capital gains while at the same time receiving some covered call income. The same is true, I believe, for JP and JEPQ. So when you combine all these ETFs into a single ETF, you're getting a diversification in terms of the underlying stock holdings as well as the underlying options writing strategy employed by each of these different ETFs. And lastly, we'll take a look at the expense ratio. So it has the HYLD ETF has a management fee of 0.65%, which I believe is fairly typical for most covered call ETFs, and it in fact includes the expense ratio of all the underlying ETFs as well. So it is not separate from the underlying ETFs. So all of it, this is all inclusive, I believe, of the expense ratios for the underlying ETFs as well. So all in all, so far, this ETF does sound like a great investment option, especially like if you are someone who is into the income oriented strategy where you are more interested in receiving a high income and you don't mind sacrificing a little bit of your total return to get that higher income. But now I'm going to explain to you why I sold this ETF after buying it last year, in February of last year. So, the main reason why I sold this ETF was simply due to the fact that the management was making too many unnecessary changes to the holdings within the ETFs. And there was one particular change which I found really problematic and which was almost sort of guaranteed to lose this fund money. And I will explain you how it actually lost this fund some of its net asset value. When this fund started trading back in February 2022, at the time it did not have the exact same holdings as you see on the screen right now. At that time, it was tracking an index known as the Selective US Covered Call ETFs Index. And this index, as you can see, consists of only seven covered call ETFs as opposed to the 10 we see in its current holdings. So let's just first understand what changes they made. So out of the seven original covered calls they held, they still retain five of them. The three Global X covered call ETFs, which are the QYLD, RYLD, and XYLD. They are also part of the selective US covered call ETFs index. So they have retained those three. And in addition, they have retained the Horizons Gold Producers Equity Covered Call ETF, which we can see right here, GLCC. And they have also retained the Harvest Healthcare Leaders Index ETF, which we can see HHL right here. So, five of them are still there from their original pool of ETFs, but they managed to replace two ETFs with new ones, which they believe would save them on the management fees and also give them more diversification in terms of the underlying holding, and would also give them a higher overall income. So the two they replaced were the Harvest Brand Leaders Income in ETF. That was replaced with JP, the JP Morgan Equity Premium Income ETF. And the other one that they replaced was CI First Asset Tech Giants Covered Call ETF. The ticker symbol for this one is TXF. So the TXF got replaced by JEPQ. Now I'm okay with the JEPI replacing the Harvest Brand Leaders ETF. That I was perfectly okay with. But what I was not okay with was the replacement of this CI First Asset Tech Giants ETF, TXF ETF, with JEPQ. And there were mainly two things that bothered me about this switch from TXF to JEPQ. Number one, the fund managers for both these ETFs employ very different covered call writing strategies to generate income, which results in different total returns for both these funds. Now, I'm not going to go into too much detail on how these funds differ, but to put it in a nutshell, JEPQ is more focused on income generation, whereas TXF is focused on income generation, but at the same time, they want to maximize your exposure to the capital gain or capital loss for the underlying holding. So TXF tends to be much more volatile in terms of its stock price movement compared to JEPQ. This could be a good or a bad thing depending on whether the market is bullish or bearish. And that brings us to the second problem that I had with this was just the timing of this switch. So they made this switch, according to me, at the worst possible time. So they held TXF during a bearish market in 2022. And as I mentioned, TXF is a far more volatile ETF as compared to JEPQ in terms of its stock price movement. So that resulted in a net asset value erosion throughout 2022 for the HYLD fund as a whole. And then they replaced it in 2023 with JEPQ, which does not actually give you too much capital gains. And we will see in a few charts now how this played out. So here we have the first chart. As you can see, this chart shows the performance of TXF in the past 5 years, but we are just going to focus on its performance, particularly in the year 2022, which was the year during which HYLD held TXF. And here it lost almost 40% in terms of its capital value. No other ETF within the HYLD ETF lost as much as TXF. And if we look next at how HYLD performed, we find that HYLD also lost considerable amount of capital value during the year 2022, a total of 26.54%, as you can see on the screen. And a big chunk of this loss was because of TXF. But what do they do next? In 2023, at the very beginning of 2023, they replaced TXF with JEPQ. And we know this for sure because of this article that they published in January 9th, 2023. It was published on the website. Adding JEPQ, selling TXF for higher yield, added diversification, lower fees. So those are the reasons they gave for this change. But let's now see how the two funds, TXF and JEPQ, have performed in the year 2023 so far. So year to date, TXF has returned almost 27%. This is just its capital gains. It does not include the additional 9% income that it provides. So we can just almost say we received a return of almost 35% if we had held the stock. But HYLD replaced TXF with JEPQ. And let's see how much JEPQ has returned. So yes, JEPQ has also returned 15.81%, which is a positive capital gain. But even if we add the additional around 10 to 11% income it provides, it still would go up to around only 26%. So it's still less than what TXF's total return has been so far in 2023. And that's really my problem over here. When this fund began, it had a good mix of ETFs that provided high income, but at the same time also gave the fund as a whole the potential to appreciate in terms of its capital value. Now the management seemed just more focused on generating higher income and not really caring for the potential of capital value appreciation. And the funny thing is that even the income aspect of the fund is not exactly doing well. So if we look at its recent distributions, you will find that it has actually reduced its distributions from 14 cents to 12 cents. So until March 2023, they were paying off 14 cents per share every month. Now they are paying 12 cents per share every month. And again, this is not a bad income, but we can clearly see there has been a reduction in the income they are paying out. And interestingly, this reduction did not happen in 2022, which was a bearish year, but it has happened in 2023, which has been a bullish year. One might think that during a bullish year, they would actually increase the income payout, but that's not the case. And I think a big part is the changes they made in the ETF. If they had simply held the original mix of ETFs, I think at the very least they would have been able to continue with the 14 cent per share payout. So that is my review of this ETF. If you found this video useful and gained some knowledge out of it, don't forget to like, share, and subscribe. See you guys in the next one.